Welcome back. This is becoming a bigger and bigger problem for U.S. housing market. Have a look at this. This was published about a week ago. I was out for about a week, so thank you for your patience here. But I'm feeling much better here. So it says housing affordability hits at a historical low for the month of August, just posted on October 19th, according to the National Association of Realtors. I did not read this report. Instead, I actually looked at the raw data and I'm going to provide my own analysis of what they had to say here. So this is pretty wild because you look at what is the qualifying income for people looking to buy a house, in this case for August, how that compares to the actual incomes that people are earning right now. And also they look at home prices and rates as well. So overall, for the month of August, the median sold price for a single family house nationwide was $413,500. And that, by the way, is about 4% higher compared to a year ago, when at that time, the median sold price was just under $399,000. Now, here's where it gets really interesting, in my opinion, because look at these rates. I mean, the average rate for the month of August was 7.15% according to NAR. However, their rates here tend to be a little bit higher compared to Freddie Mac, for example. But something to keep in mind, this is for the month of August, of course, but ever since then, rates have been increasing, right? So rates in September, for example, increased to 7.2% according to Freddie Mac. Also, an increase overall so far for the month of October to 7.6%. And again, as I note right here, rates on the spreadsheet tend to be a little bit higher compared to Freddie Mac because NAR is accounting for points being paid by borrowers. So in any case, looking at rates at 7.15% in August, in September, again, an increase of 7.2%. And as of today, which is October 30th, the average rate for October increases 7.62%. In any case, I mention this because once you release September numbers in late November, it actually will look worse than these figures in today's video, which, by the way, I should say here, their housing affordability index on a national level is at 91.7. Based on my own analysis, this is the lowest levels on record going back to the late 1980s, going back to January 1989 to be exact. So in other words, housing affordability is worse right now compared to the late 1980s, when back then rates were averaging about 10% for an average 30-year fix. Absolutely crazy. In any case, here's something you guys should be aware of as well. The average principal and interest payment, or P&I payment, excluding home insurance and property taxes, is at $2,234 per month as of August. And that, by the way, is an all-time record high, again, for data that goes back all the way until January of 1989. And again, this only counts for principal and interest payments and not property taxes or insurance. So speaking of insurance, have a look at this, because according to Policy Genius, this was announced on September 12th, home insurance rates increased on average by 21% between May of 2022 through May of 2023. So property insurance rates have been increasing greatly here. Overall, over the past 2 years, though, average rates have increased by 35%. And in fact, home insurance premiums have increased the most in Florida, a giant increase of 68% over the past 2 years. After that was New Mexico at 47%. The reason why I mention this is that when we're talking about only P&I payments right here, this is not talking about the giant surges in home insurance premiums that some people are paying right now. Now, here's something you guys should be aware of as well, because the median family income on a national level is at $98,291 for the month of August. Look at this though, the qualifying income is at $107,232 per year. Based on my own analysis here, this is the highest levels on record and only the third time it has been over $100,000 going back to 1989. On top of that, this qualifying income is more than double the income needed to buy a median price home back in August of 2019. So for example, back then, the qualifying income was just under $50,000 per year, whereas the median family income, or the actual income that people are earning back then, was at $81,468. So big picture here, what this means is that households nationwide could afford to buy a house back in August of 2019 because their income was much higher than the qualifying income of $49,000. Which, by the way, the National Association of Realtors defines qualifying income as the following: the income needed so that mortgage payments on a 30-year fixed rate mortgage loan with a 20% down payment account for 25% of family income. Now, going back to the qualifying income right now at $107,000, this of course is much higher than the median family income of $98,000. This means the average family cannot afford to buy a median price single family house right now. The reason for this, of course, is due to elevated prices as well as rates as well. And also, I just look at this, looking at pre-COVID levels. This is something I added here. Everything else is based on a download I pulled from NAR's website. But here's what I added here. And by the way, I added a note right here because I was going to make this video about a week ago, but I noticed that the median family income, the affordability index, was revised by NAR over the previous 12 months. So I actually emailed them about 3 times. They finally got back to me and said that each and every October, they revise these numbers based on government's data here. So anyways, if you guys notice that note down there, that's one reason why the stats here are different over the past 12 months compared to my previous video I made about 1 month ago. In any case, you probably didn't even notice that, but I noticed that. I want to make sure I'm providing, as much as I know, valid and also accurate information for you guys. In any case, let's look at this because this is absolutely mind-blowing here. When looking at home prices, that increased by 47% from August of 2019 through August of 2023. So home prices, or I should say the median sold price for a single family house, surged by 47% compared to pre-COVID levels. On top of that, rates have increased by 3.5 percentage points over the past 4 years as well. So we have prices increasing by nearly 50% and also rates increasing from, when was it? Back in August 2019, probably around, right there. Back then, it was 3.66%. Now this August, it increased to 7.15%. On top of that, the principal and interest payment has surged by 116% since August of 2019. That equates to $1,200 more per month to buy a median price home today compared to then. Now, speaking of a lack of housing affordability, here's what gets really interesting here because family incomes have only increased by 21% over the past several years here, whereas the qualifying income, again, the income needed to buy a median price home, increased by 116%. So we can't have a scenario or a environment in which incomes have only increased by 21%, whereas the qualifying income has surged by 116%. Also, compared to August of 2020, P&I payments have increased by 110%. Compared to 2 years ago, it surged by 83%. And that means that it's going to cost you about $1,000 more per month to buy a median price home this August compared to August of 2021. Also, an increase of 26% over the past 12 months, and that represents a $464 increase in your monthly mortgage payment. So big picture here, this is one of the main reasons why we're seeing a pullback in home buyers right now, because we have elevated rates and prices Keep in mind because these housing affordability challenges that homebuyers are facing right now, again, all-time record lows based on my own data here. Let's just kind of move on here and talk about some more leading indications of home buying demand here, because according to the MBA, 1 week ago, applications overall, which includes refis plus purchases, decreased by 1% compared to the previous week. This is for the week ended October 20th this year. So the refi index actually increased by 2% compared to the previous week, but was still 8% lower compared to 1 year ago. This kind of just blows my mind that refis are increasing when rates are increasing as well, which is telling me that more people are doing cash out refis in order to get cash because they're having a financial hardship. I'll have some data on that here very soon, because based on a report from Black Knight about a month ago, they reported out of all the applications, or not all the applications, out of all the people who have locked in a rate for a refi, about 90% of those was doing a cash out refi in which their rate actually is increasing. So this is telling me that overall consumers are remaining are kind of in a tough spot right now, because why would you refi right now and get a higher rate unless you really need the cash? So in any case, that's probably one of the reasons why refis increase, because people are doing cash out refis because they're running out of money. Anyways, the seasonally adjusted purchase index, which is a measure of people submitting loan applications to buy houses, decreased by 2% last week. And also it's down by 22% from the same week 1 year ago. Also, based on my own analysis of their data here, their purchase index is now at the lowest levels since February of 1995. Can you say a huge pullback in home buying demand? Again, due to rates and prices still remaining very much elevated. So according to Joel Kahn, who's the MBA's vice president and deputy chief economist, he stated the following: 10-year treasury yields climbed higher last week as global investors remain concerned about the prospect for higher for longer rates, and of course this fiscal deficit. And as such, the 30-year fixed rate on average jumped 20 basis points to 7.9% last week, the highest rates since the year of 2000. Rates have also risen 7 consecutive weeks, an increase overall of 69 basis points. So according to the Mortgage News Daily as of today, which is again October 30th, average daily rates, again for people with great credit, increased to 7.92%. If you want an FHA or a VA loan, it's around 7.35%. 1 year ago, average rates were at 7.08%. That's an increase of 84 basis points over the past 12 months. In addition, average rates have been hovering around 6.9 to about 8% ever since late May this year. Also, according to the MBA, have a look at this, because the ARM share of activity, these are applications for home loans for purchases or for refis for adjustable rate mortgages, increased to 9.5%, the highest levels since November of 2022. It says here the adjustable rate mortgage share of activity increased to 9.5% of total applications. Pretty crazy, because the low, I believe that was last year, that was about 3%. The high was around 12%, but it has been increasing steadily over the past several weeks because people are looking for ways to buy or refi getting a lower payment, right? So according to the MBA, the average 30-year fixed rate last week, again, was at 7.90%. But for a 5/1 ARM, that is a rate or a mortgage in which your rate is fixed for 5 years and then it adjusts thereafter or becomes variable thereafter, was at 6.99%. So some people are flocking to ARMs right now because the rate is so much lower compared to a 30-year fix. And I'll say this again, in my opinion, this is a much risky loan product because your rate is only fixed for a short period of time versus getting a 30-year fix. Your rate is fixed for 30 years. What do you guys think about this? So please leave me a comment below. Also, something that the MBA announced here as well is that the share of activity or mortgage activity increased to 31.4%. This means that 3 of every 10 applications for home loans is for a refi, and only 7% are for a purchase. This just blows my mind that 30% of the applications are still refis right now, which I would imagine that about 90% of those, again, are probably cash out refis. A couple more things I do want to mention in today's video. By the way, if you guys are still watching today's video, I appreciate you. I've been kind of a cloud in my head because of getting COVID about a week ago. So I'm doing my best here, and I miss all the reports that was announced last week. And in my opinion, these 2 reports here from the MBA and also from the National Association of Realtors are probably some of the biggest news that I saw when I was reading articles last week. In any case, here is a look at the number of people searching for homes for sale on Google here. And this is on Google Trends. The index right now is at 70. 1 year ago at this time, it was at 76. So more or less, fewer people searching for homes for sale on Google compared to 1 year ago. Also, according to showingtime.com, they look at the total number of real estate showings on a national level across North America over the past several years here. So for the week ended October 24th, the most recent data they have for us, home showings decreased by 15.9% compared to the first week this year. Compare that to last year this time, it was a decrease of 27% compared to the first week last year. And this, of course, is night and day difference compared to the giant increase of activity we saw in 2020 when showings increased by 20.7%, and also in 2021 rising 7% compared to the first week of 2021. But that's today's video. Thank you so much for joining me in today's video. I appreciate you. Hope you have an awesome day. Like and subscribe, and I'll see you on the next video very, very soon.